So our mission is to help our audience find the life-changing returns that you can only get from getting into an asset like Netflix or Walmart early. So I'm extremely excited to talk to you today, Don, because you are the preeminent expert when it comes to the currently deeply undervalued precious metal stocks. And you're also very knowledgeable in crypto. So my first question to you is, what will cause these assets to see explosive gains over the next few years?
Yeah, thanks for having me on. When I created my website for gold and silver miners, focus was for big returns, kind of what you're after. If you're going to invest in gold and silver mining stocks, which is one of the highest risk sectors out there, you want to have, large returns, outsized returns. And, for me, I always wanted, my target was always a five bagger, 500% return overall in my portfolio. And the reason why I got into the gold and silver market, looking for those returns, if you will, is kind of to answer your question, what's the case for it? Why is it actually going to happen? And I think the reason why I actually got into it is for the same reasons today people are getting into it. It's, the dollar, the money supply expanding dramatically, debt bubbles emerging. If you look at U.S. debt, the U.S. debt is now approaching $30 trillion. And it's gotten to the point now where it's almost unbelievable, where you're having economists now write books stating that debt doesn't matter. Stephanie Kelton, I think is her name. She wrote a book saying the debt myth. I mean, it's the myth that debt actually is a problem. The debt is actually a problem. I mean, it's kind of stunning, and it's like we're entering a new era where the only way that we can maintain our standard of living, our way of life, our economic structures, if you will, is to expand the money supply, expand debt, or else collapse. And this really is kicked into gear after 9/11, after 2008 recession. We really haven't had a recession from 2009 through 2020, and then COVID had we were in a recession right now, but COVID did that, and there's nothing that they could do to prevent it. But it was almost like we've gotten to this manipulation phase where they're not going to allow a recession, and they're going to do whatever they need to do. Now the Fed, it used to be with the Fed, their overall strategy was to prevent inflation and to lower unemployment. Their goal was never to increase stock values or increase the economy, which is now that's the hat they're wearing. And this is all experimental stuff. And so I think investors have to really recognize that gold should benefit from this. And I saw it a long time ago. I just saw these debt bubbles coming, and then the dollar itself. We can talk a little about that. But to me, it just all kind of adds up to a situation where you could have an increase in the price of gold and silver.
Well said. And I think it is a good summary of the issues happening right now and the debt and the terrible fiscal and monetary situations we have ourselves. And I think it's a strong case for why the underlying assets, so the gold and the silver, are going to rise in dollar terms. So with that being said, I don't think you're the type of guy who just wants to pile into like physical gold, because the return isn't probably what you're looking for, right? So what is the best way to maximize returns if this scenario were to play out of a rising gold price?
So there's different ways to play it. A lot of it has to do with your risk appetite, your risk levels. I think that it's a lot of people want to get into some of these really explosive stocks, such as the exploration plays and the development plays. But I think that the best risk reward is with the producers. And you can have, and not so much the small producers, I would say the lower tier, mid-tier producers, say $100 million up to say 3 to 5 billion. All the producers along that curve, there's about 50 of them. So you have to pick, of those 50, which ones do you want to hold? And so to give you an example of the potential here, I don't think people really understand the unbelievable leverage that's possible in some of these stocks and some of these producers. So back in 2011, the HUI, which is a mining index, it rose to 600, around 630. And today we're almost at the same price. We're 1840 gold, and the HUI index is under 300. Today it's like 290. So it's almost half its value of where it was in 2011. And the reason why is because the sentiment in the miners is down. But that gives you a lot of leverage if the sentiment flips and the sentiment turns positive. So we're looking at the HUI could easily, say, go to 1,000 if, say, gold trended to, say, $2,500. So we're looking at, the HUI is for the large miner indexes. So we're looking at the majors, the very biggest companies, the Barricks and the Newmonts. We're looking at them more than doubling in value. So for them to get to 1,000, they would probably go up, not 1x. 1x would be a double. 2x would be going up twice their current value. So if a company was at 10 billion, it would go to 30 billion. That would be the largest companies. And that's only for the very largest. That's for Barrick and the Newmonts. Now, what does that mean for the mid-tiers? So the ones that are down with the market caps of 100 million to, say, a billion, those companies are going to do twice as well. So we're looking at factors. We're looking at companies that are going to go up just at $2,500 gold. The potential, we're looking at like 3x. So we had Barrick, going 2x. We're looking at these companies going 3x. So that's a 300% return, and even more. So that's like the bottom. I'm talking about the averages, right? Then there's potential for gold to go to $3,000 or $3,500 gold. Now, are you starting to see what kind of levers that I'm talking about?
Absolutely.
It's huge, right?
Oh, yeah.
And that's just for the strong producers, right? If you look at some of these other plays, some of the more higher risk. So let's say that you go, 75% into the producers and you play around with 25% of the other higher risk areas. These other juniors, which is what we're calling the lower end, basically the juniors, the mid-tiers, and the majors. The junior categories, I think you're going to see a lot of, say, 10 baggers. If we get to, say, $2,500, $3,000 gold. But we're going to see some amazing jumps if we have a gold bull market. And, I said earlier about the reasons why I think that gold is going to benefit from our, current economic policies. So the miners have this really huge possibility if gold does go on a run, and gold goes anywhere from, say, even if we've only run to $2,200, you could still make a lot of money. But once you get north of 2,200, you get 25, 3,000, 3,500. The returns are going to be stunning. And that's not necessarily the end game, if you will. Things can get really crazy. And the silver miners have even more leverage than the gold miners. And the reason why the silver miners have more is because about 70 to 80% of the silver goes into fabrication. And when I say fabrication, I'm talking about industrial, but I'm also talking about jewelry. So you have this competition in silver between the investors and the companies that want to use it, all what I call the fabricators. You don't have that. It's the opposite in gold. It's like 80-20. 80% of gold is basically for investors, 20 cents in industrial. But for silver, the potential for what I call a shortage. There's no such thing as a shortage because price always fixes the problem, but you have basically a huge imbalance in supply versus demand. So you have this potential for like a slingshot effect in silver. And I think that really starts to come into play once you get to say $35 silver. Once you get above $35 silver, you're going to have a lot of people coming in because of the momentum. People are going to be chasing those returns. People get really excited about silver when it gets high for some reason. The retail market, well, all of that money is going to be competing against these fabricators. And once you get to say 40%, if the investors want 40%, so the supply of silver is 1 billion ounces. It's a lot of ounces, but on a dollar amount, it's not that big. If you take the 1 billion times ounces times $20, that's only 20 billion. It's not a lot of money, but 400, once you get to say investors want say 40%, that's 400 million ounces. And this year, the ETFs are actually going to swallow up that much. So you start to get this situation where silver becomes really, really interesting and very volatile. I wouldn't say volatile, but very explosive to the upside.
Oh yeah, it sounds like the perfect storm because of the industrial demand mixed with the investor demand.
Yeah.
So has the production, because the silver price has been so low, has that been minimized and reduced over the last few years? And has that kind of maybe caused a shortage in the supply?
No, we haven't had anything anywhere near a shortage. So the supply's been pretty consistent, about 1 billion ounces for like the last 3 years.
Mm.
And this year it was down a little bit because of COVID, but it would have been a billion. So we're basically right at a billion. It hasn't varied much for the last 3 or 4 years. And I'm expecting 2021 to be basically a billion, the demand to basically be a billion. And actually, I'm expecting that investor demand to be, I mean, it's going to be really interesting because last year demand, from what I'm seeing, is like 40%. So I think if it's going to be 40% again, we could easily start to see some upward pressure in silver. But the one thing I want to say about these high prices in silver and this high demand in silver, the only way you're going to get that demand in silver, the retail side, is if the price of gold goes higher. So because silver basically follows gold. I call gold big brother and silver little sister. Mm-hmm. And little sis she doesn't like to play unless big brother's happy, if you will. If your big brother's doing well, she just sits in the background and waits.
Right.
And so we need gold to say get over 2,000, and then you start to see this situation where the retail money starts to come into silver. You have a lot more people wanting silver. That's just the way it goes. But silver tends to act as a base metal and industrial metal when the economy is doing well and the fear trade in gold is not there, and basically the retail crowd doesn't really care too much. So we haven't had any types of potential shortages yet, but I think once we get to over $35 silver, it's going to start to get interesting. But we could easily see some really crazy things. We could see silver go up $10 in one day. It wouldn't surprise me.
Yeah, no, definitely. And I really like your methodology about investing in terms of going after the producers, because you're factoring in risk and reward. A lot of people might just want to go for the cheapest penny gold stock they can find and think, oh well, the reward here is huge, but the risk is also really huge. High. Yeah, it's just right. Yeah, I mean, these companies inside and out, so you definitely understand that.
Right.
So okay, so you like the producers. A lot of people really favor royalties. They say, I like royalties because there isn't the risk of the mine flooding or XYZ political risk, and it can be diversified, more diversified than just a mine or two. So what has better leverage to the price of these metals, royalties or miners?
Interesting. It's about the same. Okay. I mean, it's actually better for the royalty companies. Royalty companies have a lot higher margins, much higher margins, because their costs are all, they basically put in their cost early through a contract. The way royalty streams work is the royalty companies finance mines to get built. This is the main way. They'll finance a mine to get built. So they'll give a company, say, $200 million or $50 million to, build a mine. And then from that money, they get paid later once the production goes into effect. And then when the production goes into effect, they just get paid a royalty or a stream, and it's usually at a fixed cost. And it's usually, those costs are usually very low, how much they have to pay for the gold or silver. So their margins are through the roof. And the royalty companies tend to have the highest valuations because of those margins. So they usually get valued anywhere from, say, 25 times free cash flow to, I would say, maybe 35, 40 times free cash flow. So they have these really, really high valuations. And because of that, and so royalty companies have done really well. And I'm I'm not a big royalty guy, because there's certain things about the whole royalty industry that I actually think in some way they're kind of net negative to the business industry, because what they do is they hurt companies on a certain level. Because let's say, I'll give you an example, for instance, Alexco. So Alexco right now, they have to give like 25% of their revenue to wheat and precious metals on a stream, and they have to give it at a fixed cost. And so every ounce that Alexco mines, they lose money. On those 25%, they lose money because their cost is higher than they have to pay Wheaton. And that's how it is on most of these deals. These companies, they get, they do get this money up front, which they need, but the way that they pay it back is kind of onerous. They don't get a break even on their cost. I wish these deals were a little more fair. If they were, to me, I just don't think they're kind of a one way a lot of times. The royalties have a really good contract, if you will. I would say 90% of the deals are favored, cut fairly highly to the royalty company. So overall, I mean, I'm an investor in the whole industry, and that's the reason why I don't own any royalty stocks, is because I just think the whole setup of the whole thing is just a little one way to a certain extent. I don't know if it overall, if it helps. Which way does it help the industry? Does it hurt the industry? I know it's hurting them in a certain extent. Maybe it's helping them because people are able to build their mines. But I wish the banks would do this. But we're seeing royalties break out left and right. But one thing I'll say about the royalty plays is that if you're going to do royalties, I really recommend just staying with the real strong ones. You have Franco-Nevada's at the top, and then you have Wheaton second, and then you have Sandstorm third, and you have a Cisco Royalties fourth. I would stick with those four. And one other thing I just want to bring up, I think the royalty model is going to be fine. You can compare it to basically producers. I think they're going to perform. They probably perform, as good as a major, maybe a little better, somewhere in there. It's hard to say. One thing about the royalty models you need to keep into consideration, this is my own personal view, my own personal kind of theory, if you will. My theory is that once silver gets over $50, and once gold gets over, say, 2,500, once gold and silver basically break out big, right? You're going to see some of these companies, I don't know who, but one of them, eventually one of these companies is going to stop paying the royalty. They're just basically going to say, this royalty is not fair. This is such a one-way thing. I'm not honoring my contract, so I'm not paying you until you renegotiate the contract. Someone's going to do that. And once that happens, the model a certain extent breaks, right?
Yeah.
So there's that. I just wanted to throw that out there because it's my own personal theory. But on the whole, the royalty model is working. It's going to continue working for a while. It's starting to get a little crowded. I mean, you're starting to see a lot of royalty plays in there. There used to be like 10 royalty companies out there. Now there's like 20. They've proliferated quite a bit. One thing I wanted to circle back to, I think some of your listeners are probably thinking about this. We talked about, you mentioned risk reward on the producers.
Yep.
What's the difference in the risk reward of a producer versus, say, a developer or an exploration stock? So the one thing, we'll start with an exploration stock. The one way what you want to do to avoid basically losing money on an exploration stock is you want to make sure they have the goods. So how do you determine if a company has the goods? Number one, you can catch a company that breaks out fairly well. Say a company goes from like 25 million or 50 million and doubles or triples. That company's breaking out because something good's happening, and then you can go and see why it's happening. You can go and check their drill results. So basically what you're doing is you're kind of chasing a trend. and that maybe the follow-up holes don't work, but at least you have something going, a little bit of something's working that you're not basically investing in a dead stock. So a lot of times what happens is people invest in what I call dead stocks. And that's a stock that just hasn't done anything yet. And all you're doing is betting that it will. Don't do that. Wait till a company has moved. Make sure there's a reason for you to own the stock. So there's that trending. The other thing you want to do is you want to make sure that there's what I call an excellent discovery hole. Now, what is an excellent discovery hole? You can check some of my tweets and Twitter. You can try to find it. You can basically, I'll mention it here. You can send me a direct email asking for a free trial on GSD, and you can go and check the forum, and it shows you what is an excellent drill hole. But basically what you do for an excellent drill hole, I'll just give you an example of, say, gold. So you want to multiply the grams per ton times the width, and you want it to be, I believe, over 200. And so anything over 50 would be good. That's a good hole. And good holes are fine for when a company's adding ounces, but a good hole isn't good enough to bias the stock. You want it to be an excellent hole. So you want it to be greater than 200. So you got, say, 10 grams per ton by 20 meters. That would be 200. There's a beautiful, excellent discovery hole. That's how you're going to reduce your risk from these exploration plays. For a development story, what you want is a company that has a path to production. So how you have a path to production is basically they're giving you guidance. It's like they already have a couple of, say, scoping studies. They have a PEA, a preliminary economic assessment, and they're giving you guidance. Okay, we're going to do a feasibility next year. We're going to do permitting the year after that, and we're going to try to get it into production in, say, 3 years. If they're giving you a path to production within 3 years, at least 3 years, 3 years or less, then that might be a pretty good story. And then, of course, there's a lot of other factors that go into play, but the path to production is really important. A lot of times what people do is they get in too early on development stories, and it takes forever to get to first pour, and it costs a lot of money to develop a stock. And what happens is you get diluted into the ground. So let's say you buy it at $1 a share, and then 3 years later it's at 90 cents because of all the dilution. That happens a lot.
No, that's really, really good to know, because a lot of people can talk about the areas they're going to mine, but don't talk about all the capital it's going to take to get there, and just keep getting diluted and diluted and diluted. So that's just really valuable advice, to go for companies that already have something to their name, even though they might have already run up in price a bit, right?
Okay, yeah. One of the best times to invest in an exploration stock is after it's went up 100%. It's like when a stock goes from 30 to 60, 25 to 50. The reason why it doubled is because they're onto something, right? And they're onto something big. It's like, that's the best time to get in. Then those stocks tend to keep going on. And I'm talking about the initial double, right? That initial move.
Yeah, right. So that's important. I'm sure that debt is also pretty important. Is that a big risk that you look at when you evaluate companies?
Yeah, so you're going into some of the details, right? So debt is just a balance sheet. And so if you're going to invest in miners, you just have to read my book. There's not that many books out there that explains how to do it. So I have a textbook, and you get it free if you're a member of my website, the digital version, and paperback on Amazon. But it's basically a textbook. It shows you how to do it. You're going to learn a ton if you read my book. So if you want to invest in these miners, you have to read my book. There's nothing else out there. Otherwise, you learn on your own. It'll take you 2 years, so you're going to save a bunch of time. But the digital version, especially if you sign up for 2 weeks for free, you're going to get the free digital version. You're going to learn a ton.
Yeah, so that leads us into the service you're offering, because everyone wants to multiply their money by a lot. Everyone wants to get into great companies early. Unfortunately, there's so many out there to choose from, and that comes to kind of what GSD offers. So what service do you offer, and how could it help investors that want to get into these companies early?
Yeah, it's a really good website for anybody that wants to invest in mining stocks, gold and silver mining stocks. So first off, the database is comprehensive. So there's like 825 gold and silver miners in the database. So pretty much every miner in the world. I have a few that are missing. The only exchange I really don't do is Germany, but anything on Germany is usually in London or New York. So I pretty much cover them all. I don't want to do this like a commercial, but I'm kind of, you asked me to explain what it offers, so I guess I better.
Yeah.
The newsletter has 10 different lists on it of various different categories of mines, the stocks that I think are worth looking at, if you will. But the whole purpose of GSD isn't to provide picks. It's to provide data for you and to provide what I call leads, so you can do your own due diligence. So I'm trying to get everybody, to read the book, learn how to analyze these stocks, learn how to do your own due diligence, and then use GSD to help you to find stocks. It's going to do a really good job of that. Plus, we have a forum, so we have 1,000 members. So the forum has a lot of good info in it. When I have 1,000 members, there are a lot of people in the forum. It's a private forum. The only people in there are members. So you're going to learn a ton of information there. So just overall, definitely worth the $150 a year, put it that way.
Yeah, absolutely. And I can see one question rising where it's all these great companies to pick from, but then how do you structure your portfolio? You don't just want to go all in on one. Do you have a diversification strategy? Like, do you maybe go in 10 equally distributed dollars in each one, or?
Yeah, it's a good question. And that's one of the reasons why you want to read my book, because there's different strategies on how to build your portfolio, which I explain. And I go into detail to do it as well. For
Yeah.
me personally, there's two styles of investing in the miners. One is what I call a trading strategy, and this is probably the best way to make big money. And that is, you only invest in 20 to 30 stocks at a time, and you basically have high allocations to those 30 and you trade them. So you're constantly basically selling the losers or adding to the winners. It's basically a trading strategy. And so you're basically on top of those 30. And the hard part is there's a lot to choose from. So if you only pick 30, which 30 do you pick, or which 20 to 30 do you pick? It's not easy to choose how you're going to do that. And there's such a vast array of different types of stocks. You have the small cap exploration, you have the small cap development, you have some of the higher cap development, you have optionality plays, you have all the different categories of producers. There's just a wide array. You have the royalty stocks. How do you decide if you're only going to do 20 to 30, which 30 to pick, right? It's not easy. So me, I don't have I'm not a trader per se, because I don't know which stocks are going to be the big winners, if you will. So I want to have what I call exposure. So the way that I do it is I put it in the book, is I use a pyramid approach. And the pyramid approach, the foundation, the bottom of the pyramid is physical metal. So, and I don't do physical gold, I do a lot of physical silver. So my foundation is physical silver, and you could also consider cash as the foundations too. But I've come to hate cash, and so I want to get my money working for me instead of sitting on cash. Yeah. And then one level above the base is the majors, and the majors are basically the lowest risk of your producers. And then above the majors is your mid-tier producers. And then above the mid-tier producers is your small producers. And then above that is your development stocks. And then above that is your exploration. Now, this is a pyramid, right? So as you go up, you're having less and less allocation. So I only have 8% of my portfolio is in exploration. And I think about 15% is in development. So I'm about 25% into the high risk area and 75% into the lower risk, basically the producers. And so if I'm going to do that, I mean, in theory, I could use that same theory and trade it and do 25 to 30. I could, but I prefer to have exposure. So what I do is I have low allocations to each stock, and I have a lot of stocks. I own over 100 stocks, and most of my allocations are under 1% per stock. And I basically say you should never have more than 3% on a single stock. And ideally, you should have very few stocks that are 2% and higher. So the vast majority of your portfolio is all your stocks. We're talking about individual stocks, not so much ETFs here, but individual, because ETFs have less risk. But individual stocks, I don't like to have exposure 2% or higher. To me, that's just it makes me uncomfortable. So I like to have, less than 1% per stock on average. So I basically have a whole bunch of stocks. I just have a lot of exposure, if you will. That's my personal way to do it, to diversify out. But you have to decide, if you want to be a trader, to go to 30, or if you want to have more exposure. I know a lot of people, from what I've said, a lot of feedback, a lot of people, they think that 50 to 70 is a good where they like to be.
Wow.
That gives them enough exposure, because when you're 50 stocks, if you think about it, 50 stocks doesn't go that far when you're looking at exposure, because how many, once you put, 20 producers and, 20 exploration plays, and then 20 development, there's 60 right there. If you want to get kind of a full exposure, anything less than 50, it's kind of tough.
It seems like that's how venture capital firms invest, right? They invest in like a whole bunch of tiny little startups. And then if one goes public, they make all their money back. Is that kind of how this style works?
My style. So first of all, I'm only looking for three baggers or higher.
Mm.
If I don't think a company can be a three bagger, then I don't want anything to do with it. So the only stocks that I really exclude from my portfolio are the really, really big majors like Newmont and Barrick and Goldfields. These really, really, really big companies, because I don't think they're going to be three baggers, although they might. But I'm like, okay, I don't need to buy the very, very, very top. But once you get a little bit below that, say 10 billion or less, then everything's pretty much a three bagger, I think. So I'm trying to find, and that's the minimum. So my minimum is three baggers, but I'm trying to look for, ideally, I'm looking for 100 bagger, right? I want really big outsized returns. So if I'm exposing myself to 100 stocks, of those 100 stocks, I'm expecting 10% of them to be 10 baggers.
Yeah.
Right now, my portfolio, I will definitely hit that. I have quite a few 10 baggers already. So, and we're not even at $2,000 gold, because I've been doing this for a long time. But my portfolio is set up, since I've only been looking at 3+ baggers, my portfolio is set up to have at least 10 plus, I call it 10 bagger home runs. So say 10 home runs. I don't think I'm going to have a Barry Bonds season and have 50 home runs, but the whole idea is to hit a lot of home runs. And so that's the reason why I own a whole bunch of stocks. So I'm looking at, if I'm owning 20 development stories, I'm hoping maybe 5 of those guys are big hits. And a lot of my producing stocks, I got into them early. So those right now, if you bought like First Majestic, probably you're going to, if silver goes to $100, it's probably going to be maybe a 7 bagger, which is outstanding, right? But if people that bought it earlier, such as myself, you're going to be well over a 10 bagger if you bought, if you got in early. So a lot of these producers, now it's kind of tough to get 10 baggers and producers, but a couple of years ago when gold was at $1,500 or less, you could get these producers a little cheaper, but you're still going to be able to get, some 5 baggers, no problem. But maybe, so where you're going to get your 10 baggers are really in your development and your exploration stories.
Absolutely.
Yeah.
Yeah, it's interesting you point out First Majestic, because like I'll look at that and say, oh, the market cap is 2.4 billion. How much room does it really have to go up? You're saying that could be a 7 bagger potentially with higher silver.
Yes, I'm thinking it's going to be a 7 baggers, my current target for $100 silver.
Yeah.
And it could be even, I think that's my minimum target for $100 silver for them.
With regards to gold and your analysis, like what is the best way that people can come find you?
The website, just go to goldstockdata.com, and they want to follow me on Twitter as well, because I'm on Twitter a lot, but that's the 2 places. And then once they go to Goldstock Data, they just go down to the contact. I'll get the email and just shoot me an email and ask me for a free trial to GSD. And then once you get the free trial, you can download the book. The book's on the main menu, the digital version. And then if you want the hard copy or the paperback, just order it on Amazon. I personally prefer the book. I just like to, hold it in my hand. But some people prefer digital now. So
yeah, it's just so convenient. Unfortunately, just have it downloaded to your phone, but it's not as fun to read. That's for sure.
No, it's not as fun.
I'll definitely be checking all that out personally. Do you have a quick second to talk about your thoughts on crypto?
Oh yeah, let's talk about crypto.
This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented.